Well, thank you for the invitation. Thank you, Philippe. Thank you, Silvio. This is based on the chapter on the book, and listening to the presentations, I noted it's a review of a literature, so it's not, there's nothing particularly original in what I'm going to say. In most ways, it's somewhat trivial. Yep. But I think it does do something that is relevant. Sometimes because we don't do these exercises very often. It's, think a little bit of the limitations of conventional arguments. So what we got to thinking, before coming here is that there is less thinking done in that piece about the connection with income distribution. So I'll try to say something about that. And I also been reading more about the long term, sort of. So it's about the trend, so that's obviously not the title of the paper, but I think it's in the subtitle. The conventional explanations of low interest rates, which are fundamentally about the lower interest rates in the last 30 years or so. But there is some literature now on a secular decline on that, which I was somewhat unaware of. I mean, and I think it's relevant too. So I added a few slides and want to reflect a little bit on that. So, again, I'm just going to go through what seems to be, a review of the literature. Most of the names of the people associated to this are well known. It's Ben Bernanke, Larry Summers. Oops, I just lost my microphone. The others are, Charles Goodhart that wrote, was this guy called Pradhan, a book that it's very, it is quite illustrative of what mainstream neoclassical thinking on the topic is, and somewhat surprising, I would say, of how reflective of the relevance of heterodox economics for the mainstream is something that often, surprises me. So absolutely oblivious of what's going on. And then the work of Mian, I should say in his favor, he does cite Minsky. He's the only author that we would call heterodox that it's cited, but in ways that I think are completely oblivious to the place in which you should put Minsky, so the uses that Minsky would have. So I think at the end of the day, all of those are based on some version of the, loanable funds theory of the interest rate. So it's very conventional stuff. It's about, marginal productivity of capital and what's going there. That's only Larry Summers. I would say in his favor, at least within the mainstream, I think that that's the best explanation. All the others are about savings behavior and demographics. I should say I do start, the paper with Krugman, and Krugman, of course, is the guy that said back in '98 that it's back. It's the liquidity trap. So the idea of a low interest rate as being a liquidity trap is associated to Krugman. His paper doesn't say anything about the causes. He was at Bucknell to give the Godly Tobin lecture. And he did say, I don't know if he said it in the lecture. The lecture is uploaded on the blog. So, the blog is Naked Keynesianism. But he did say either on the lecture or at least at dinner later that he thinks it's a demographic, the reasons for the low interest rate, and hence the liquidity trap and whatnot, it's at the end of the day, demographic causes. So very much in the same side as, I would say, Bernanke and Goodhart and, and so forth. Mian is the only one here that actually does say something, I should say, also about income inequality playing a role in the... So I do mix what I would say that this is for... No. What? No, not to pass. I want the one that, if there is one to point, but the top? Yeah, it's there. Oh, yes. I do put it takes some ability to do this. Okay. I do take this literature, which I think it's different than this literature. So, and they're not often put together. But I think the notion of a global financial cycle can be seen as being related, and the work of Shin in particular, in which he talks not of a savings glut, but a banking glut, seems to be, again, relevant in this context. Again, they tend to use this. I mean, you think Mian using Minsky Shin and Len Ray, really important work in within the mainstream, and Claudio Borio on this global financial cycles. They do remain with a real sort of explanation of the remuneration of capital. So all of those don't escape, at the end of the day, the conventional view of what determine the real causes of interest rates, which is a long-standing thing in economics, going way before, even, classical economics in some sense. That debate is, within the classical Ricardo. Oh, Jesus, this is not for me. I would probably should. Yeah, I know. Somebody has drank too much. And we're still in the afternoon. It's not even afternoon. Okay, well, I'm gonna put it here and hope I'm not gonna make a mess. Okay, so I'm gonna briefly talk, if I have time. I'm gonna jump things. I'm gonna have time then. And I'm going to talk a little bit. I want to talk about the long-term sort of explanations of lower interest rates. It seems to be an interesting sort of topic. And I'm going to say a couple of things, not bore you, but we can discuss in questions what I think it's a more reasonable explanation for those things, that what they have. I'm going to. This is all well known for everybody here. So there's, as I said, a long tradition that does suggest that interest rates are determined on the real side of the economy. Those traditions are very different. So that, the Ricardian sort of theory is very different than the sort of, somewhere here. The Ricardian theory is very different than the marginalist story of this. But, at the end of the day, it is a real story. I think that there is an attempt in Keynes to abandon the real story. How good the attempt is another discussion, not for today. I assume a lot in this discussion that the capital critique is well understood, and that sort of the limitations of the neoclassical version of real interest rates is sort of relevant. Of course, the people in the middle of this debate have no inkling that there is a problem associated to this. So that again, says something, how this has vanished. So the issue, the problem, of course, is what you can see, hopefully somewhere here. Where do we see it? No. Yes, I think it's going to be better. So the sort of, the typical thing is, the decline in interest rates. I'm showing, this is of course nominal, and you have also consumer price index, so you have a sense. So the important thing that I think it's worth remembering in all of this is that if you look at this, it used to be from the 50s onwards that interest rates were for the most part positive, real in the United States. But since the 2000s, they have been for the most part negative in real terms. Interest rates have been negative. So they are still, even with a hike in the interest rate, they can hike it quite a bit and it will remain negative. It doesn't mean it has no effect. Coming from a developing country, Argentina, we're going to talk about inflation. I probably will talk a little bit about inflation in Argentina, I suppose, which is hitting 90% or so. Nominal rates do matter. At the end of the day, the nominal rate is the one that competes with the depreciation of the currency, and the one that is, sort of relevant for portfolio decisions that where people go to dollars or not. So nominal rates do matter, but this negative, even negative, the hike of the interest rate in the United States and its impact on mortgage rates and and housing market will have a significant impact on the business cycle. So that's an important thing to bear in mind. So that's the thing. Nominal rates have gone down significantly. Real rates are negative, throughout. So that's the issue. And if you think of the secular decline, here you have it from 1317, I think it is the number there, until 2018, I think. You have something similar. This is a rate that this guy Paul Schmelzing created. He calls it supra-secular decline in global interest rates. Global is of course mostly Western Europe. It's he does tell it 78% of whatever the GDP of the world here, measures that. And it's something that it's there in Homer and Scylla, the classic book for those that have not read the famous history of interest rates, which is it's mostly about data, and it does show in a more haphazard way the same sort of declining trend there. So there's not necessarily anything new, but the fact that he creates a consistent, coherent series and so on, several series, I should say, public, private, and so on and so forth, which it's good work in and of itself. The interpretation of that is considerably more problematic, but there is good work in the empirical sort of showing of this sort of long trend. Also, you should say with some bouts there of negative rates, overall, when you think this is the real rate overall. So the difference with the previous one that I was showing nominal rates, here I'm showing real rates. He calculates the real rates. As I said, the basis of this is the idea that something happened here with savings and investment. So the way Krugman explains the zero lower bound, which he calls liquidity trap for some reason, it's the idea that there is a negative natural rate of interest, and he's very explicit. I should say that's another thing that it's interesting of the evolution of things. The natural rate of interest as a concept vanishes at some point in the 40s. It's not seen anymore where it went, and it reappears on in the 2000s. And so Keynes did kill the natural rate of interest, in the general theory, in the sense that he says, I think it's a terrible idea. I don't think he got completely rid, but the intentions are clearly there. So and I think that that's a very important part of the discussion there. That's a rabbit hole I don't want to go today, but it resurfaces with Friedman. So Friedman resurfaces, he does say it's the, it's Wicksel's sort of natural rate with the natural rate of unemployment, but they had to reinvent it as the natural rate of unemployment. It remains there. So in terms of history of thought, there is some interesting sort of element there of what's going on. But by the 2000s, it reappears. So they're shameless. Now it's out there. It's out of the closet, the natural rate of interest. And so I think Krugman was important in that, pointing out, he claimed that this is his most important paper, which I find sort of surprising. I think it's not a particularly good paper, and not the best paper. His best paper is I told him, your best paper is the Terms of Trade one, the Unequal Exchange, that has a very radical reading of it, but that's another story. I could have said it was the one with Lance Taylor, but that would have been mean. It was his first paper, so it was his best and his last good paper. But no, actually the Terms of Trade paper is really good. So I'm briefly not going to discuss much. I don't know how long do I have? I have 30 minutes overall. Okay, so no, I know, but it's overall 30 minutes. So the story in Bernengo is the global savings glut. It's put it in simple terms, China, and entering. So if the question in the 90s was what will happen if a billion Chinese enter the labor market, will it affect your wages in the mainstream? Here the question is the entering of Chinese consumer savers will affect the global interest rates, and the story is that they do. So the global savings glut is an increase in the global savings, and this is increasing the global savings. Savings and investment reduces the natural rate of interest. And and that's very explicitly. I have a quote here: to reverse the various policies that generate savings, for working to free up international capital flows and reduce interventions in foreign exchange markets, and so on and so forth. So I should say on this, he's also on liberalizing capital flows. I normally like to use the Metzler diagram. It's, I think, a sort of a good way of thinking about it. So surplus countries, mostly China, you think a natural rate, another natural rate. If there is free movement of capital, you should have an equalization of those. So so that would force the capital flows will go to the higher rate of interest, and will reduce, hence increase the savings, the amount of money, funds available in the United States, and of course reduce it in China. So you move towards a lower rate of interest. So that's the sort of logical argumentation behind this, and the basis for Bernanke's sort of argument. I should say the interesting thing is the Metzler, when he wrote this, he called this the Keynesian model, which, again, you scratch your head a little bit. I mean, Keynes does have a marginal efficiency of capital, but certainly he didn't think in terms of intertemporal consumption and whatnot there. So, but for what's worth, that's the theoretical basis. Summers, of course, was sort of critical. They had a debate on that. He goes back to Hansen, and he thinks in terms of population dynamics and growth. That was the basis of Hansen's paper. I had not read Hansen's paper before this, I should say, and I'm ashamed to say, but I went and read the paper. It's an interesting paper. It is demographics. It's certainly based on unconventional neoclassical story. Also says something about Hansen that I was sort of thought that was an institutionalist, and I've been learning more and more about some institutionalists, at least, those that derive from commons and whatnot, that have more marginalism, more neoclassical economics that I expected in them. So Hansen certainly does, and the idea then is on the investment side. So is that lower population growth will sort of bring down through the demographics less needs of investment, and so the investment curve moves downwardly, and hence reduces the natural rate of interest. So that's the argument. I think that argument, if I'm going to give the best to marginalist arguments, go in line with, again, he's a very supply side, in terms of how he tells the story, but it's a book worth reading. I think it's an important sort of contribution to macroeconomic debates, and by Robert Gordon, David's brother. On the sort of requirements of the third industrial revolution, which I think it's at least a better argument, and I'm willing to live with that kind of explanation of needs of spending in infrastructure and whatnot, not as an explanation necessarily of a low natural rate of interest, because there are many problems with that kind of story, but of lower rates of growth in general, and maybe an impact on investment, sure. Whether that's a good explanation for the rate of interest, that's a different story. But at least, as I say, Summers is the only one in all of this that it's talking about the investment side rather than the savings side. And who am I to say good things about Larry Summers? But he's the best in this debate. So I'm saying something good about Larry Summers. So Goodhart and Polan. And again, I'm a big fan of Goodhart. Goodhart is the closest to at least the catalyst part of MMT within the mainstream. So he does know, the idea of money coming from power and so on and so forth. But this book tells you quite a bit about the way he thinks about the economy, and it's very conventional, the book. The way he thinks of population dynamics and demographics is a little bit in reverse to Summers. He's not thinking, so he's thinking of dependency ratios, and he's not thinking in terms of the effects on investment. He's thinking of the effects on savings, and so the effect, so as I sort of highlighted there, perhaps I can manage to. I can apparently, but as I highlighted, I did manage. Low-key technology. So the increased population reduced dependency ratios, leading to higher economic growth, and so you have it, in reverse, in a sense. Higher savings associated with younger labor force explains, a lower natural rate of interest. So, in many ways, he thinks that there is a great reversal coming soon, and he explains inflation on the basis of these reversals in demographical, tendencies. So I find this quite surprising. He does try to connect this to what he calls a debt trap, but financial factors and whatnot. I'm gonna, jump all of those. And they're in the paper, of course, and you can look at those there. But they're, again, they're just to emphasize, even when they introduce all of these authors, so we're going to move in that direction, authors that introduce financial preoccupations, they still have the basis of the natural rate of interest in the back of their head. So that's what's underpinning all of this. So the debt trap, the financial factors, our Vixelian differences between monetary rates and real rates, and of course what governs all of this is the real rates. So it's in that tradition. So Mian is the one that introduces the idea of income inequality. So in terms of inequality, if there is a claim that I thought about inequality at all in this paper, is that Mian does think in terms of inequality, and as much as Bernanke and Goodhart, he tends to think in terms of the effect of that on savings. So at the end of the day, it's the finance, when it's introduced, also will be sort of something that affects the savings part. So think as if you're in the investment and savings sort of graph, you're adding sort of financial aspects, so that sort of enhance the savings side of the so you create extra liquidity, which is like extra savings, and that's the part that brings the rate down in that story. So because of the increase in inequality since the 80s, and the effects of people at the top saving more, the notion is that higher savings rates are pushing the natural rate of interest. And again, that's the basis of the argument, which is a strong argument to make, that though that sort of incredible decline here of the rates, which it is from the 80s, it's income inequality. I think that's it's clearly a policy sort of variable. Is that no? You're just I see hands. Don't you had your hand like this? I tell my students, that was the guy that saw dead people, and I see hands. People do this and say, "Oh, are you asking a question?" So I see hands, not dead people. Thank God. I prefer to see hands. Hands up, I should say. Okay, so it is, as I said, it is sort of I went too much. Yes, no. There we go. I think it's a peculiar sort of discussion, and so he is concerned with things that may be seen as a paradox. Besides citing Minsky, he does talk about the idea of macroprudential policy, but you have to think what he's thinking about macroprudential policy. So when I think about macroprudential policy, I'm thinking eliminating the volatility of capital flows that create such a mess for developing countries, in terms of the exchange rates and and so on and so forth. What he is thinking is eliminating what he sees as the excesses of the financial market, and and clamping on excessive credit. So it's a story of excessive credit. So it's a story of excessive credit, expanding the savings curve, if you want, and and generating low rates of interest. So in that respect, it's not a particularly illuminating thing. I again think that this is an important literature. Why? Because I think there is a lot of good data in in the analysis that the BIS has done. Claudio Borio is crucial in this. They have shown, Ellen Ray, Claudio Borio have shown clearly that there is a global financial cycle, that in those cycles flows are procyclical. They have shown that a good chunk of that is associated to gross flows rather than net flows, driving the volatility, and hence might be associated to issues of financial crisis. So all of that is, I think, relevant and should be read. The problem is that the framework in which they sort of use it is very conventional, and that's often my heterodox people, they tend to think that Borio and all those guys are quite heterodox, when the opposite seems to be the case. I should say, I also think that the paper by Ray on this, that that it's not a trilemma but a dilemma. That the trade-off is really between capital mobility and independent monetary policy, irrespective of the exchange rate regime. I think that that's an important contribution, and something that I think hasn't received as much attention as it should. I think, at least among heterodox people. So I think that that's an important point. As I said, Sheen's idea of a global banking not financial. I don't know what I said before, but it's a global banking glut. And again, this points to the idea that, and he says explicitly, expenditures require financing, not savings. Good for him. But at the end of the day, they end up with a story. If you think of the Borio's financial cycle, the preoccupation is that what finance does is it exacerbates the fluctuations around a natural rate, and he wants a new version of a natural rate, and that new natural rate, should take into account these financial variables in order to even come further on the expansionary policies and liquidity and so on and so forth. So it's to be more restrictive. So if you follow actually the policies, oh my God, so we'll be hiking interest rates before and higher than what we're already doing. So the literature, as I said, it's essentially a literature that the real forces behind the determination of interest rates are still the underpinning factor that determines what's going on overall. Broadly speaking, so I think that as I say, both Keynes and Minsky do keep to some extent the idea of marginal efficiency of capital, and I think that's why I said I'm not entering into those debates. I think the capital debates should be taken seriously, and I assume they are. So I think you can have a theory in which you have a monetary theory of distribution, that you have interest rates as being the determinant sort of variable, that it's a policy variable, so hence exogenous and so on and so forth. And so you have to have some explanation of why this policy variable has changed. Of course, I put there in the first graph the inflation rate, because those nominal rates have come down together with the inflation rate, and they're going to go up with the inflation rate. So it's policy oriented and related to the issues associated with that. The inflation of the 70s was conflict inflation. We're going to talk later today. I don't think the inflation now has anything to do with conflict. I don't think conflict is sufficiently strong in the advanced economies, despite of all the strikes and things, unionizations. I think it's still too weak, but that's another story. But I think there is, in the broad story of Minsky, something that has to be sort of recovered, and this idea of financial instability, which I would associate, to the regulation of financial markets and liberalization of capital flows, is at the end of the day what has forced, because of the recurrent crisis and collapses of the banking sector, rescues, and that's what's behind the humongous expansion of the balance sheet of central banks. It's what's behind the low rates of interest, and so it's a question that it's associated to this sort of financial instability. So again, I don't explore much that. I leave that as, so this is, as I say, an essay of review, and I don't explore much my own sort of suggestions. So these are seen as suggestions. The alternative view. I'm going to talk, a little bit like the alternative view for, why interest rates are in the short run low is financial instability, but for the longer view, and I should say something in the longer view of why he thinks the natural rate of interest is sort of, so he's very angry with Mr. Summers, which is the one I told you, it's the best of all the other guys. So it's sort of a peculiar thing, but he suggests that, and I have a long quote, but it's worth long-term real rate should always have been expected to hit zero bounds around the time of the 20th and 21st century, if put into long-term historical context. In fact, a meaningful and growing level of long-term rates should have been expected to record negative levels. There is little unusual about the current low interest rate, low rate environment, which the secular stagnation narrative attempts to display as an unusual aberration, linked to equally unusual trend breaks in the saving investment balances or productivity measures. So very conventional sort of story of what's going on. You have the saving investment balance, the productivity, that's what he's looking at. And his point is, it's always there. So what is the logic of this? It's accumulation of capital. So the savings are bringing eventually, there might be shocks to productivity and, shocks to the marginal productivity of capital. There might be sort of, demographical things that change the savings temporarily. But, at the end of the day, the long trend is capital is abundant. And because it's abundant, so it's a theory of the abundance of capital. And so it does have, in a peculiar way, although, Ricardo certainly wasn't marginalist, but there is some hints of the stationary state, which Ricardo is very clear that he didn't believe was any time close or whatnot. But in the idea that Ricardo does suggest that because eventually technical progress will not be, coming in agriculture, and you'll be forced to, get down and produce with lower productivity, that will of course squeeze profits, and I'm almost done. Squeeze profits, and you'll reach this stationary state. So there is an analogy here. This is the marginalist version of that argument. So I make the new differences between those two things, but at the end of the day, it's this kind of sort of idea. And what I would suggest, so here very briefly, as an alternative way of, so he does also criticize, I should say, with this, the notion that it's institutions. He said institutions do matter, but the rates of interest. Oh, what happened? Oh yeah, it's a few more. Sorry. The rate of interest. Yeah. So if you think of the Glorious Revolution, 16. Around here. So, he says, yeah, they do have an impact. You bring down interest rates. There is sort of in the 18th century, there is a decline in interest rate, but the decline started before, and with the Napoleonic Wars afterwards, you have it coming back again. So there's no reason to think that this is, the Douglas North new institutionalist kind of stuff. It's what's behind the lower rate of interest. So it's not institutions, lower risk. So he says it's something beyond lower risk. It is, it's this sort of abundance of capital. So in my view, what I think it's important in all of this, it's what I call developmental state, something that it's not necessarily what people call the developmental state. So I tend to think of the developmental state, if I'm going to be close to MMT people, it's the ability to spend more or less without limits in your own currency, which is complicated in the early modern periods in history because, they're all tied. It starts as international currency, as me and Louis-Philippe published a paper back in 2003, so almost 20 years ago in the journal Post-Keynesian Economics, which I think it's our first paper, both on the fact that early money was private money in the transition to capitalism, and banking money, in a sense, if you want, in Keynes' terminology there in the treatise on money. And I think that ability to, but I think at the end of the day, so first of all, it's because it's starting, it's Italian city-states, so they're small Italian city-states. They don't have a large sort of national state. So the first that has that, it's England and the Bank of England. Public banks already existed, of course, since the 1400s. It's only with the Bank of England that kind of thing starts. But England, of course, it's still tied to gold. And I should say the important thing, so in the paper in Rope, in the debate with Eichengreen, one of the things I do say, which as far as I know, I don't know anybody else that had said that in that way, so I think it's a tiny little contribution there to that debate. Is I think that what England did is they demonetized silver. So the demonetization of silver goes hand in hand with the rise of the pound to power, and the dollar comes with the demonetization of gold, of course. So it's this developmental state that it's capable of. You cannot default. So we're on the same page on that. You cannot default in your own currency. And that's the story that says why interest rates can go down. Of course, in the short run, they didn't go down because of that. They went down for the reasons of financial volatility and so on and so forth. So just very briefly, and I assume he left, so I can talk as much as I can. I want. Oh, they passed the baton. These people are horrible. So there is an issue here of whether they're going to remain and whether they, can remain sort of low in the medium term with an acceleration of inflation. And I tend to think that this is, so we're here, and sort of starting again. They try to, reverse, and we're hiking the rates of interest and whatnot. And my guess is that they won't be able. And the reasons for that has, again, nothing to do with some natural rate. The reasons for this will be that they will throw the economy, if they persist on this, at significant rates, even with real rates being negative, they will throw the economy into recession. and they'll be forced again to rescue a good chunk of the, of the economy and flood again, and increase the size of the balance sheets and reduce interest rates. So I don't think in the which is a good thing for developing countries. So if we're going to talk about inflation in developing countries, is what I think I can sort of contribute something to the debate later on. It's that's actually the only good thing about this sort of situation in advanced economies, is that it has created a permanent sort of, low rate of interest environment for developing countries, and only countries that have mismanaged their ability to accumulate reserves, like Argentina or Venezuela or something like that, have been unable to have relative stability, and even growth. I mean, well, Brazil is another case that we don't have growth, but it's a very different story, and these reasons for Brazilian suicide are beyond the scope of what I have to say. So the point of the review is that conventional views of, it's amazing. I always say it's to my students, it's amazing how reasonable people, and I say this, thinking about Krugman, for example, that started all of this with the liquidity trap and so on and so forth. And it's a reasonable person. You sit to talk with him, he's in favor of almost everything Steve has written for the program, the entry on Krugman. Very reasonable man. So he agrees with, he's pro-choice, he's, for some degree of given, paying debts, I mean, he's not the most progressive, he's not a Bernie guy, I'm not saying that. He's a reasonable guy. So he thinks global warming is important and we should be doing more. I mean, you would sit and agree with him on almost everything. And then you look at the explanation for low rates of interest, and he comes up with demography. And you have to scratch your head. Why would a reasonable person, very intelligent, capable of understanding complex things, say such an idiotic thing? And that's the classical economics here. It's what it does. So he ends up explaining the, and then I'm sorry, I'm not saying this out of, I'm not trying to be, it's really, I think that's the conclusion of this review, is that it says it leads to very silly explanations of historical trends that are relevant and important. I have not again reflected much. How long do I have? 1 minute to say something about inequality? 1 minute to say something on inequality. So what does it say about inequality? I think that, in a sense, inequality, and I didn't explore that, inequality is somehow at the heart of what's going on, at least in the short term. I cannot say that in the long term. I haven't thought a little bit, but I was thinking a little bit about it in the short term. So part of the story is that from the 70s onwards, because of big inflation, high inflation, and the combativeness at that point of the labor force, the elites in advanced economies broke the legs of the unions and the ability of wage workers to resist. So wage resistance is somewhat gone, and that obviously is a question of inequality, and it's that question of inequality that and the accumulation of wealth at the top that led to this sort of boom of financial deregulation, because it's the same change in power that allows for the breaking of the legs, as I say, of the unions. It's what allows for deregulation and liberalization of financial markets. And so those forces in power that generated inequality are the same forces that led to the financial volatility and instability that is at the core of the lower rate of interest. So inequality does play a role, although I didn't say that in the book, and I think that that's probably something to add to that discussion. Thank you. Sorry for exceeding my time.